What exactly do we mean by profitability in a green hydrogen context? Unlike traditional fuels, the economics of hydrogen aren't just about fuel price per unit. Profitability here means the ability to cover capital and operating costs, service debt, and generate a return on investment under various offtake and pricing scenarios. And that's exactly what a well-structured Excel model can help you understand before you ever break ground. The foundation of any green hydrogen financial model is the assumptions sheet. In a quality Excel workbook, like the one provided in our green hydrogen plant financial model template, you'll start by inputting technical, economic, and policy parameters. These include installed capacity of your electrolyzer system, its efficiency, in kWh/kg of hydrogen, system degradation rates, annual capacity factor, capital expenditures, CapEx, operating expenses, OpEx, electricity pricing, water costs, and debt equity split. Each one of these variables has a massive impact on project economics, and making them editable is key to testing different scenarios. Once you've set your base assumptions, the next step is calculating your annual hydrogen production. This is done using the installed capacity, operating hours, and system efficiency. For example, if you have a 10 MW PEM electrolyzer operating at a 70% capacity factor, the model will estimate annual electricity usage and convert that to kilograms of hydrogen using the specific energy consumption per kilogram of H2, typically around 50 to 55 kWh/kg. From here, you'll get your total annual hydrogen output, which forms the basis of your revenue and cost calculations. Speaking of revenue, this is where your offtake assumptions come into play. Are you selling hydrogen under a long-term contract, PPA style, spot market prices, or a blended model? Are prices indexed to natural gas, carbon credits, or fixed? In the Excel model, you'll input your expected sales price per kilogram, escalation rates, and contract structure. The revenue sheet will then multiply annual production by the sales price, allowing for escalation year over year. You can even include additional streams such as oxygen sales, green certificates, or ammonia production if you're modeling integrated value chains. Now let's shift to costs. CapEx is usually modeled as a one-time upfront investment, but it's important to allocate it across various cost centers: electrolyzers, compression, storage, water treatment, civil works, and grid interconnection. In our downloadable Excel model, we've categorized CapEx with built-in ratios based on real-world benchmarks, but you can customize them to match vendor quotes or feasibility studies. For OpEx, the model includes electricity costs, often the largest driver, water consumption costs, maintenance, labor, insurance, and contingencies. These are usually structured as both fixed and variable components. The total operating cost per year can then be calculated and benchmarked against revenue. Next comes the core of project profitability, calculating the levelized cost of hydrogen, or LCOH. The LCOH is the discounted cost per kilogram of hydrogen over the life of the project. It accounts for all capital and operating costs, financing costs, taxes, and residual value, and divides it by the total hydrogen produced during that time. It's the single most important metric when comparing projects across technologies or geographies. A good model uses the discounted cash flow, DCF, method for LCOH, aligning with international standards such as NREL's H2A model or ARENA frameworks. In our model, you'll see a dedicated tab where you can see LCOH broken down by cost component, CapEx, OpEx, energy, and water, and even visualize how it changes with electricity prices or capacity utilization. Now let's talk about financing. A profitable project on paper won't get built unless it's bankable. That's why our Excel model includes a financing module that handles debt structuring, loan amortization, interest payments, debt service coverage ratio, DSCR, and equity returns. You can input your financing assumptions, interest rate, loan term, grace period, repayment method, annuity or linear, and see how they impact your debt service schedule. If you're working with export credit agencies, concessional loans, or blended finance, you can layer those in as well. This is crucial for demonstrating creditworthiness and aligning with bankability criteria. After you model costs, revenue, and financing, it's time to bring it all together in the cash flow statement. This is the heart of the model, tracking inflows and outflows year by year across your project's lifetime, usually 20 to 30 years. You'll see EBITDA, EBIT, net income, and free cash flow, and use these to calculate net present value, NPV, internal rate of return, IRR, and payback period. If you're developing projects in emerging markets, these metrics are what development banks and climate funds use to assess your proposal. The beauty of an Excel model is that it allows you to run what-if scenarios instantly. What if electricity prices drop 20% due to collocation with solar PV? What happens if CapEx rises 15% due to inflation or supply chain bottlenecks? What if water access becomes constrained and costs triple? Using data tables and sensitivity analysis, you can create tornado diagrams that show which variables have the biggest impact on LCOH and IRR, helping you to risk your assumptions and focus your efforts on what matters most. But Excel isn't just about numbers. It's also a tool for communication. Our financial model includes a dashboard summary that aggregates KPIs into a clean, investor-facing format. It displays annual production, CapEx, OpEx breakdowns, IRR, NPV, LCOH, and DSCR, all in one sheet. That means you're not just building a model, you're building your credibility. And if you're pitching investors, grant agencies, or project finance lenders, being able to show a clean, logic-driven Excel model can make or break your fundraising effort. Now, you might be wondering, can I build this from scratch? Technically, yes. But why reinvent the wheel when you can use a pre-validated model that incorporates best practices from real-world hydrogen developers, project financiers, and institutional investors? Our Green Hydrogen Financial Model, available through ReneEnergy.com's Green Hydrogen Project Development and Financing course, was designed for exactly this purpose. It's the same model used in Module 10 of the course, where we guide you step by step through feasibility planning, financial structuring, and profitability analysis. In fact, the course itself complements the model perfectly. Over 10 modules, you'll learn how to evaluate project sites, conduct resource assessments, secure permits, structure offtake agreements, prepare investor pitches, and mitigate development risks. You'll gain insights from case studies like NEOM, HyDeal España, and the Asian Renewable Energy Hub, and get access to templates that help with permitting, stakeholder mapping, budgeting, and more. When combined with the Excel model, it becomes a full project development toolkit that saves you months of guesswork and tens of thousands in consulting fees. To wrap up, modeling green hydrogen profitability in Excel is both an art and a science. It requires technical understanding, market awareness, and financial acumen. But with the right tools and frameworks, it becomes not just possible, but empowering. You'll move beyond vision statements and into executable projects. You'll understand your project's true break-even point, design better offtake contracts, and speak the language of banks, governments, and investors. Warning emoji, disclaimer, this content is for educational purposes only and does not constitute investment, financial, or professional advice. All projections are based on model assumptions and actual results may vary significantly. Consult qualified professionals for project development decisions. Walkthrough or full case study. Let's build a clean hydrogen future, profitably.